Okay, so let's move on. Let's have a look at the returns. Let's do some analysis on the returns. I think the first thing to say is that there's been quite mixed. You know, there's been some returns that have gone down, but in general, it's been some small positive gains. But you've got to remember that's from last March, previous month, where we actually saw some really strong gains. Okay, so let's have a look at the returns themselves. I think the most surprising one for quite a lot of people will be the UK. So obviously there's been a lot of nervousness around Brexit. There's been very much divided opinion on what is happening with Brexit. But as you can see, it's not had such a huge effect on the UK stock market return. Actually, if we look at currencies, sterling's actually gained during the month of April, so it's made up from some of the falls that it had earlier in the year. Okay, so let's have a look at China now. And I think, if we go back to January, obviously China was in the news. It was quite negative, really. But now investors are looking towards China in a more positive way. So they're wondering if they should increase their positions or not to this area. And that's because the Chinese government, they're increasing the stimulus package. And that's to stimulate economic growth. On the flip side of that, though, I think investors need to be aware that what happens if US bond yields rise, what happens if we see a rise in inflation? Because that can be quite negative. That'll increase the debt costs that China have. And debt is the primary tool that China uses when it's looking to stimulate the economy. Moving on to fixed interest. I think there's been a sort of real dichotomy of views within fixed interest, particularly in global high yield. So what you've seen is some investors are looking to reduce down their positions, so to increase the credit quality of their portfolios. And then you've got other investors who actually see real value here. What we're seeing is that spreads are now, they've come in a little bit, but they're still pricing at sort of almost recession-like levels. One of our fund managers, 7IM, they've looked at the correlation between US stocks and US high-yield bonds, and they see quite a strong correlation there. So they're actually buying US high-yield bonds because they see more value in this area. Okay, so let's move on. Let's have a look at the outlook. And I think investors really need to concentrate on the positive things that are happening in the market rather than being bogged down with negativity. Good opportunities exist for investors to find, but they need to be dynamic and they need to be nimble to take advantage of these. From our perspective, we can use our managed portfolio series to help mitigate some of this volatility. So help diversify by geography, by asset class, but now also by investment style as well. Okay, so that's everything from me on the markets. Thank you.